All right, good afternoon. This is Martha Evans from Stross Law Firm. Unfortunately, Howard Stross is running a little late. He had another event this morning. And so I'll be introducing Scott. Today, our guest speaker is Scott Maurer from Advanta IRA, and he's going to be talking about self-directed IRAs this morning.
All right. Thank you very much, Martha. I appreciate you all having me on and the opportunity to participate in your webinar and hopefully teach some people some new things about retirement planning today and retirement plans. And it's going to be a little bit different than maybe what individuals may be more accustomed to hearing when it comes to retirement plan. We're going to talk about self-directed IRAs today. And today's presentation is rather it's short and brief. I'll give you a lot of some good information, but there certainly is a lot more that can be covered within self-direction. I would encourage you at the end to contact me and get some more information as well. Again, my name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I'm also a licensed attorney. I don't do any legal work, though, for Advanta IRA. I've been with the company now since early 2006. Since that time, I've done a number of things. I originally was hired to handle a lot of the transactional transactions that we saw within our office, of people buying and selling real estate and other different types of assets within their IRA account. And I've transitioned the last few years really to doing more of the education and marketing side of our business as well. A quick disclaimer just about Advanta IRA. One thing we are not investment advisors and we are not investment providers. We do not endorse any products. We strictly act as an administrator for individuals looking to diversify their IRA holdings into what we consider to be alternative investments, and we'll go over those here today. We don't give legal, tax, or investment advice. If you were looking for someone in that area, certainly if you're looking for legal advice, Howard would be an excellent source to talk to regarding any legal questions surrounding self-directed IRA accounts. But if you have any tax questions, there's certainly some things we can answer when it comes to IRAs, but as far as giving actual tax advice, talk with your accountant or CPA. I can refer you to someone there. And again, make sure you know when you're looking at making an investment, make sure you know who you're getting involved with, make sure what investments you're actually doing. We cannot, again, give investment advice. Our job is to process transactions and investments as the clients have directed us to, and we simply make sure that things get appropriately titled and the right steps are followed. But as far as whether or not an investment is a good or bad idea for you or for your retirement plan, that is where you need to rely on outside sources, or certainly perhaps yourself as well, to make those determinations. Just a quick background on our company. We've actually been around since early 2004, and the only thing we do is offer self-directed investment administration and record keeping. So we only handle what's considered qualified money. That could be in a 401k fund, an old employer's plan, any type of IRA, Roth IRA. Those are the only types of funds we are allowed to hold. So if you had some money in a savings account, we cannot hold that. We cannot record keep that for you. But again, what we offer is, since we don't sell any products, is the ability to hold the assets that you feel comfortable holding within your retirement plan. For a lot of our clients who live in the Tampa Bay area, we obviously are local to them and they can drive to our office, sit down and meet with us. But even for clients who are outside of our geographic area, we still have a local feel for our clients. We have an account manager program where every new client is assigned to a particular account manager, someone who will help you all the way through your transactions, answer any questions. So regardless if you're geographically close or not, you're actually dealing with a person on the other end of the phone. You're not dealing with becoming an 800 number, or becoming a number within the system and then calling an 800 number anytime you need any help. You'll actually have a direct link to somebody who can help you through that process.
And Scott, you've got a couple other offices, isn't that correct?
We do. We have our office in Tampa Bay area that services obviously most of West Central Florida. I'm actually at our office in Atlanta right now, so we have an Atlanta office, and we have a couple others in Florida as well through our sister company, Advanta IRA Trust. One of the biggest questions we get asked, I think, whenever I'm talking to someone about self-directed IRAs, is someone will explain what it is that we do and the ability to invest in alternative investments, and someone will just simply look at me and say, "Why haven't I heard of this before?" And so anyone on this webinar might be asking, why haven't you heard of a self-directed IRA account? And I think the biggest reason individuals are not familiar with the ability to invest in real estate, the ability to invest in private mortgages and things we'll talk about today, is simply that most IRAs are administered by banks and brokerage firms, companies that are offering you investment products, mutual funds, stocks, bonds, CDs, etc. they are not interested in allowing you to diversify into real estate. The IRS allows you to invest in a much broader range of investments, but they do not require each custodian to offer all of those possibilities. So Charles Schwab could offer real estate, but they're not required to do so, and so they simply choose not to and have their clients invest only in those products which would they sell. Again, there's only a few exclusions and a few things you can't do within a self-directed IRA, and that's as we talk about what's allowed and what's not allowed. People are very surprised to learn how short the rules are when it comes to talking about what's prohibited within an IRA account. I had no idea all these other investments are possible. Currently, I think self-directed IRAs add up for probably maybe 4 or 5% of all IRA investments. So the bulk of the cash that is in retirement plans in this country is held in more conventional assets, CDs, money markets, mutual fund stocks. I don't think the reason why 95% of people have their money in those types of accounts is because they're satisfied with it. I think a lot of people simply don't know that this is even possible. Two of the main reasons I think we see people invest into real estate, and we see a number of other assets as well, but predominantly our clients, the people that come to us, are looking to invest their IRAs into real estate. And I think for a lot of clients and for a lot of individuals, the IRA provides them with a new source of capital. They might already be real estate investors. They hold a portfolio of properties already in their personal name or through maybe some LLCs that they've set up, but they didn't realize their IRA could be used to buy more property. So they have this kind of other bag of money that is sitting off to the side that now they can touch, now they can actually use to invest into alternative assets. Additionally, there's the aspect of the fact that the investing within an IRA is tax deferred or tax free. So any gains you have within an IRA investment, whether it's a mutual fund or a piece of real estate, you don't pay tax. The IRA itself does not pay any taxes on those gains coming back into the account. So if you're looking at making an investment that could realize you quite a nice return back into that given time, you may not want that on your personal tax return. You may be in a higher tax bracket as it is. So why not do that investment inside your IRA and defer those taxes into the future? Again, as far as the types of assets, we see any kind of real estate, whether it's raw land, commercial property, or residential condos, residential single-family homes is probably the most common thing that we see. You can do rehabs and flips. There's any type of real estate. It comes with a deed. Your IRA can own it. Now, there are some restrictions. We'll talk about what you can do with that real estate. But as far as the type of asset, any type of real estate can be held. And also what we call paper assets, any other type of documents a lot of times related to real estate. Could be an IRA lending money to an individual in the form of a mortgage and having a piece of real estate secure that loan. Tax lien investing, also very popular with a lot of our clients, is investing in delinquent property tax bills. But again, there's a number of other paper assets that you see: option contracts, unsecured notes, debentures, even some joint venturing, clients who are investing with other real estate investors and allowing that person to be responsible for the flip of the property and then simply lending them the money to do so. And there's another another catch-all, other alternatives, LLCs, partnerships, movie projects, precious metals, foreign currency. Really, the list goes on. And the reason why, again, is IRS only limits you in very narrow circumstances to the types of assets that you can hold within your IRA account. As far as the accounts that can be self-directed, any type of IRA, whether it's a traditional IRA or a Roth IRA, a lot of traditional IRAs are started when an individual leaves an employer, who in that employer had offered them a pension plan or a 401k, and you're able to roll that money from that traditional or from that employer's plan into a traditional IRA with no tax consequence. The Roth IRA is a tax-free vehicle, very popular with financial planners and financial advisors, if possible, to have a Roth IRA. The benefits of a Roth are that are going forward, all of your gains are going to be tax-free rather than tax-deferred. With any type of IRA and most 401ks, with the traditional, the SEP IRAs, the Simples, and 401ks, the earnings down the line will be taxed at ordinary income. You get the benefit of at least tax-deferring. But the huge benefit the Roth IRA has is ultimately that it's going to be tax-free. And again, any account here on this slide can be self-directed. If you're a solo, self-employed individual, the SEP IRA, the Simple, or the individual 401k often are your best bets for contributing more money in a given year to your IRA account. Another question we get from time to time is individual, I have money in an IRA. I have it with a brokerage firm. I'd like to self-direct it. How do I get that money moved in order to self-direct it? I don't want to pay taxes. I just want to move this money over and preserve the capital to make an investment. And it's very simple to do. It's a matter of transferring the funds, and a transfer is moving funds from one IRA account to another IRA account without the client touching the funds. It's considered a trustee-to-trustee transfer. Since you don't touch the money, it's a non-taxable, non-reportable event. You can actually transfer money between IRAs as often and whenever as you'd like. It's also possible to do a direct rollover if you have that employer-sponsored plan, like a 401k or a 403b or a pension fund. You can roll that money into an IRA without touching the funds. Again, if it goes wrong, as it goes directly from that 401k administrator to the IRA, it's a non-taxable event. There's an indirect rollover, is another way to take money out of an IRA. If you take a distribution from an account and put it in your personal checking account, if you move that money within 60 days back to an IRA, ultimately you are not taxed on it. But that can only be done once per 12 months, and we highly discourage individuals from moving money in that fashion.
I want to jump in here. Again, this is Martha Evans over at Stross Law Firm, and that is, you think you're going to do it in 60 days, you get very close to the deadline, all of a sudden you're over the deadline. There's a lot of tax consequences with that, and so that's the most prone to having accidental issues with that one as well. So we would not suggest that either.
Right, and that's a good part, Martha. And the IRS clarified this if you just actually starting this January. Prior individuals, let's say, take a distribution from their Schwab account, roll it into their Fidelity account, then take a distribution from Fidelity and roll it to Advanta, etc. And the IRS clarified that you can only do that once for all of your IRA accounts. People were misreading the rule, thinking they could take an indirect rollover from each different IRA they had, but they said no. It's one per IRA, and so that's something very good. Thank you for clarifying and agreeing with me on that as well, because it just is a bad idea, not only because you have the 60-day rule and people procrastinate, but also just because you inadvertently take a distribution down the line thinking you can do it again. And that money is forever out, like you said. It's heavily, there's a penalty if you're under 59.5, and you have the tax inclusion as well if you do an improper rollover. It's important to note, again, the transfers and direct rollovers are unlimited, and most importantly, earnings within an IRA. Any money you make within an IRA, there is no cap on how much you can make in your IRA. So if you're flipping a house, you're buying stock, it doesn't matter how much that asset grows to or how much profit you realize, that all comes back in your IRA, either tax deferred or, again, tax free if it's a Roth IRA, but there is no cap on the earnings within an IRA. This slide I included, and a couple of years ago I had a real estate agent come up to me and say, we've been buying money in our 401k and our retirement account for years. We didn't know about your company, but what they would do is they would simply take money out of their 401k, use it to then go buy a piece of real estate and hold it as a rental property. And I told them, unfortunately, I think you've been doing this all wrong in a way. Because they were taking the money out of the plan. They thought that they didn't realize you could self-direct your money into those types of assets. They would pull the funds out of the 401k, pay taxes on it, and then use the resulting amount left to actually buy and self-direct and buy these different types of assets. So they were actually losing probably 20 to 30% of their purchasing power because they were taking the money out of the plan. If they'd instead rolled that money from that 401k into a self-directed IRA, they would have not paid any tax and actually preserve that full $100,000 in this example to use going forward, rather than having a resulting $70,000 or $80,000 with which to work. Now again, that said, the IRS rules are very narrow. There's only certain couple things that you cannot do within a self-directed IRA. So when the rules were written back in 1975, when IRAs were created, the IRS said the two types of investments you cannot hold within an IRA are life insurance and collectibles. And collectibles include your antiques, your artwork, some stamps, some rare coins. As far as precious metal coins, those are certainly permissible if it's a gold or silver American Eagle. But these are the only prohibited investments that you cannot make within an IRA account. They didn't write in real estate. They didn't make a list of all the things you can do. The IRS simply said you cannot buy life insurance or collectibles. However, the other area, though, where they did put in some restrictions that comes into play when we're talking about, for instance, a real estate investment, And there are also a number of disqualified persons who are prohibited from transacting with an IRA account. So if it is your IRA account and you're looking to make an investment, your IRA cannot transact with any of the persons or entities on this slide. So you, as the IRA owner, are a disqualified person. Your spouse is disqualified. Your parents and grandparents, your kids, grandkids, and also spouses of those lineal descendants as well are prohibited from transacting with your IRA account. That includes any business or entity that is owned or controlled by one of the above. As far as what does that mean? What is a disqualified transaction? Well, for instance, your son owns a piece of real estate. Your IRA cannot buy it from him. He is a disqualified person. Your IRA cannot purchase it from him. If your IRA owned a piece of property, you cannot lease it to your daughter. You can't allow her to stay there free. You cannot stay there free of charge as well. It's got to be strictly hands-off when it comes to making the investments within the IRA account. Again, you can't lend money from your IRA to your son or to your father, or your father's IRA lending it to you. Importantly as well, if you're going to be purchasing, if you're, for instance, buying a rehab property, or maybe even buying a rental property that needs some fix-up, your IRA buys the property, it needs to be hiring a third party to actually do all of the work. You yourself are prohibited from doing it, and you cannot hire your son or someone else who's disqualified as well to do that work. And that's very important. Whether you pay somebody or whether you pay a disqualified person or whether you do it free, it's going to be prohibited either way. You also cannot use your IRA to make a down payment for a mortgage and then personally guarantee the remaining amount of the purchase price. The IRS requires any loans to be non-recourse. And I can tell you for the most part, we don't see a lot of non-recourse loans within the IRA world. It's pretty much IRAs paying cash for a piece of real estate. It is possible to partner with your spouses or their IRA account. So that's something I'm going to cover here through a case study. I'm certainly be happy to answer questions as we go through it in just a moment. Again, just some other things to think about with prohibited transactions. Your brothers and sisters, other family members are not disqualified, so you could transact with a brother or sister or other family member who's not considered disqualified. But if you're going to do so, we recommend that you do it for a fair market basis. You don't want to invite IRS scrutiny as to why you're doing a transaction with one of those individuals and not charging them a fair amount of interest or not making it the same deal you would do with a third party. You cannot use a middleman between your IRA and a disqualified person. So if your son owns a piece of real estate that you'd like to buy with your IRA, you can't have your son sell it to a friend and then have the friend simply sell it back to your IRA. The IRS considers that to be a step transaction, so even though you took everything out one step, it is still going to be prohibited. Again, you can't use your IRA owned asset for your own benefit or enjoyment. So I mentioned with real estate, you can own any type of real estate, but again, the restrictions are with what you do with that real estate. Again, you can't use it yourself, so no vacation homes, no primary residences are permitted to be held within an IRA account. And again, you also can't provide the equity, provide the maintenance for that type of asset as well. We'll go through a case study to illustrate how the process works for two individuals, and we'll assume that Paul and Linda are husband and wife. So again, Paul's IRA could not sell something to Linda's IRA, and Linda's IRA cannot sell anything to Paul's IRA, but if they each had money in an IRA account and they were looking at buying a piece of real estate, it is possible for them to partner on a transaction and make a purchase using both of their IRAs in conjunction with each other, as long as it's done at the same time. So in this case, each of them has a modest amount in their IRA account looking to buy a piece of property, but they find a house that is more going to cost them more, not only to close on, but also to get the work in it to get ready to rent, costing more than either one of them has within their own IRA account. But by combining their two IRA accounts and using it to purchase together, they can make the purchase and then split the net cash flow and incomes going forward. As far as the relationship between our clients and what we do at Advanta, Paul and Linda are first going to open up and fund their account. Fill out our application paperwork to establish the IRA, going through simple application procedure, and also filling out a transfer form. As I mentioned a minute ago, they can transfer money from their current IRA in whatever amount they want into their Advanta account, and then they will find the investment property. Again, we are not going to go out there looking for a property for them, recommend any particular property to them, but they find the property and they make the offer to purchase. And they will work with us then on getting us what we call a purchase authorization form, essentially just a simple sheet telling us what asset it is that they're purchasing. They would list, say, the property closing price is $100,000. They're each going to own 50% of that property in their IRA. And most importantly for us, they will give us the title agent's information so that we can begin working with them on the closing documents. So in advance, Paul and Lynn's account manager will talk with the title agent, make sure the documents get prepared with both IRAs in the name on the deed. And then we will, once the documents have been prepared correctly, we will send everything to Paul and Linda for them to look over and approve for us. We are not going to sign any documents. We're not going to send any money until Paul and Linda have approved of the paperwork for us. And once they've approved, we sign on behalf of each IRA account. We wire the money to closing, and then going forward, the deed will get sent to us. Again, now what would the deed look like? And this is important. If you're looking to write a contract and you're ultimately looking to close, the buyer's name and ultimately, again, on the deed, the grantee's name needs to be reflected as the IRA account. In this case, it's Advanta IRA Services for benefit of Paul's IRA as to a 50% undivided interest, and Advanta IRA Services for benefit of Linda's IRA as to a 50% undivided interest. Again, if it was just one IRA purchasing it, you wouldn't have the as to a certain percentage language. It might just be Advanta IRA Services for benefit of Paul's IRA and then his account number. Again, this is the wording, the legal wording that must appear on the deed for a purchase going forward like this. And again, it's important to note that the percentage that each IRA will own in this real estate is based on what amount it has contributed. And for sake of easy numbers, Paul and Linda each contributed 50% towards the purchase. But if Paul's IRA had more, perhaps his percentage would be 60 or 75%, and Linda's would be adjusted accordingly. But the percentage does have to be based on what comes from each IRA account. It would not be possible if Paul put more money into the deal to actually take a less percentage than it would have been kind of on a pro rata basis. Now going forward, they've completed the purchase. They worked with us all the way. They got the contract written in the name of the IRAs. We helped them sign the contract. Well, all the way through the closing process with them, with the title agent, making sure the documents got prepared correctly. And then signed the documents, made the purchase, and then going forward now their IRAs each own 50% of this particular property. As such, any expenses, for instance, the repairs they're going to make before they could even get the property to rent, but then also going forward, any taxes, any property taxes, any insurance, if there's any HOA or condo fees, those expenses must be paid directly from the IRAs based on the percentage of ownership. So for instance, for Paul and Linda, they will simply send us the tax bill. We'll get a check cut from their accounts, equal amounts coming from each of their two IRAs. So our job at Advanta is to act as the record keeper and hold the title to the asset. Since the Schwabs and the Fidelities of the world are not willing to hold real estate in your account, we will, and we'll make sure it gets titled correctly. And then once the property is purchased, we will process the checks out for expenses, and then also we will receive and deposit the income back into their account as well. Now, if your IRA doesn't have enough cash in it to make the purchase, what are your options? Again, most of our clients, I would say most of the real estate purchases we see, the IRA simply pays cash for the whole property. But if you didn't have enough in your IRA, you could use the partnering technique as we just showed. Now, in the last instance, Paul and Linda each used their IRA accounts, but it is permissible that, say, Paul could have used some from his IRA and some from his personal funds, or Linda's personal money along with Paul's IRA. Again, the important thing, though, is just that the income and expenses and the ownership get split proportionally according to the ownership interest. And if you partner with someone who's disqualified, again, it's okay to partner with someone who's disqualified, but you can never change those percentages down the line. So Paul's IRA in that last example could never buy out Linda's IRA, or he could not sell his interest to Linda's IRA since they were husband and wife. If they were not related, then it would be possible or permissible to do that. Again, I mentioned it's not often that we see individuals borrow. It is permissible, though, for your IRA if you make up a shortfall with a loan. However, the rules the IRS has put in place is that the loan has to be a non-recourse loan to your IRA. The IRS Code Section 4975 prohibits any type of personal guarantee from you on behalf of your IRA. So your IRA makes the down payment. Your IRA actually, or we sign on behalf of your IRA signing the note, And again, the loan has to be non-recourse. So the lender understands that should there be any default on the loan, the only thing the lender can do is simply take back the property. They cannot come after you. They cannot come after your IRA for any difference. So the rents in that instance would come into the IRA, and the IRA would then in turn make the loan payment out of the account. Well, that concludes kind of my brief presentation. I'll certainly, if there's some questions involved, I'd be more than happy to answer those or talk about other aspects of self-direction. As I mentioned, there's a lot more to it, and we do webinars and live seminars quite often, and you can see what's coming up on our website at advantaira.com. We do seminars on using an LLC to buy real estate or use a trust, something that I know that Howard has helped many of our clients with in the past. We've also seen individuals doing private lending, your IRAs, lending in a mortgage or notes, and there's some certain different rules and different things to talk about. So a lot of our webinars will focus on different aspects of that, and today was kind of just a brief overview of at least what is possible to get somebody's mind kind of open to the different types of assets that are out there. So please go to our website. You can call me or email me with any questions that you have. I'd be more than happy to talk with you, set up a time to meet in person, or just answer your questions on the phone as well.
Scott, this is Howard Stross.
Hey, Howard, how are you?
Hi. I'm well, thank you. Yourself?
Very good.
Good. I came in a little later here. I had traffic problems getting to the office. But I wanted to mention to the folks that I actually have an account with Advanta, and I also have a single-family home that I own through my IRA, and I have had that for quite some years. And it does work. I find having an LLC is very helpful, and there are the rules that Scott, of course, touched upon, and that are very important to adhere to. But as long as you stay within the rules, you'll be just fine, and it's a great way to invest if you don't want to just be in the stock market. Yes. And Scott's all the people at Advanta I found to be, very nice people. They answer the questions. They actually return your phone calls, and not all of the custodians and administrators are made the same. Advanta, Scott didn't ask me to say this or pay me to say this, but I just have experience with them and know they do a good job. Certainly, you should talk with Scott if you think there might be a reason that you would like to get into investing in something besides the stock market, particularly in real estate. So.
Sure, Howard. Thank you very much for the kind words. I mean, I do think there's as with any business, we have there are other companies that do what we do, but I really feel that our benefit and what we offer is really just superior customer service of instead returning phone calls, having an account manager for each client. And just kind of treating people as we would, the way they should expect to be treated.
And you get back to people very fast too. So it's so many institutions now you work with today, and gosh, you call them and they don't call. You call them again, and then the person's not in. I mean, you just can be forever trying to get somebody on the phone.
Sure.
Or the phone line is busy all the time when you call, and you're on hold, and I'm sure everybody's experienced that one before, but that has not been my experience with Advanta. So,
well, good, very good.
Not even close. So, I think Martha, who was on this call in my office, Martha Evans, started out because I was caught in traffic. She's now writing something to me, so she wants me to apparently mention something. Oh yeah, there's. Our next event is in March. Do we have a date for that, Mark? We don't have a date yet, but that'll be broadcasted by email to people who are on our email list. And also, there are other webinars that we have done, this one included, that will be on our website. It's Stross Law, just STROSSLAW.com, and you can go to that and you can click on and listen to other webinars, and we also have some audio recordings too. And in addition to that, we have videos too. So, Scott, I want to thank you for taking time out of your busy day and talking to folks and explaining how the IRA accounts, the self-directed IRA accounts work.
Sure, Howard, and thank you very much for having us on. We appreciate any chance we get to talk, and certainly your clients are probably people who would be interested in things like this, something that's a little bit different, outside the box. And like I said, we're very happy to come on anytime you'd like to have us.
Well, we'll certainly have you back again. We get questions all the time here. A lot of times there's so many of them, and I know you can answer a lot of them because they're not really an interpretation of the law necessarily. They're just what has to be done, and I know you all know how to you know you're not going to take somebody on if it's a prohibited transaction. You're going to be doing the right thing so that your clients stay out of trouble.
Certainly.
And with that, I'll say goodbye and look forward to visiting with everybody again on one of our webinars in March.
All right, thanks, Howard.
You're welcome. Bye-bye.